Hello, and welcome to Dividend Learning Channel. We all love stocks that pay dividends consistently over the years, and what is better than a Dividend King company? Today, we will be looking at a Dividend King stock in the industrial sector that has increased its annual dividends for 52 consecutive years. Illinois Tool's work is among the favorite stocks for investors as it is a well-diversified company that makes it more resilient in market cycles. Current market price is $239.9. Stock price is currently trading at 5.95% higher compared to 52 weeks ago. Highest price over the past 52 weeks was $264.2, while the lowest price was $214.6. Market cap is $72 billion, which is above the $30 billion mark I am usually looking for. Stay with us as we take a look at company background, current news, financial statements, ratios. Finally, we will be looking at dividend history, dividend growth, and most importantly, the dividend safety score. Before we jump into it, please hit that subscribe button as it really helps the channel grow and motivates us to keep the videos coming. An extremely important fact for IEW is that it has a well-diversified business portfolio comprised of 7 market-leading segments that operate in industries where product performance matters most to the customer and the best solution wins. No segment generates more than 20% of total revenue, allowing this well-run conglomerate to reduce volatility that comes from a market cycle. Keeping up to date with current news is vital as you do not get these information from numbers or ratios. Company has a stable underlying demand and supply chain that helps operating margins along with customer mix and product line simplification. OEM segment revenues are up 8.8% year-over-year. Operating margin is also aided by decreasing cost of sales, while free cash flow is expected to be more than 100% on net income in 2023. There is always the flip side of the coin, and Illinois Tool is facing some problems as well. Weakness in semiconductor-related business is denting revenues, while construction product segment is down 4.2% from 1 year ago. Company has a well-diversified geographical customer base, but the fluctuations in exchange rates had a 0.4% negative impact on total revenue. Ongoing automotive industry labor strike has forced the company to lower expectation. Lastly, cash and cash equivalents are lower than short-term debt, which means that the company should find a way to repay short-term debt as it does not have the available cash. Now let's take a look at the income statement. Revenue for the last 5 years has grown from $14.77 billion in 2018 to $15.9 billion for the year ended December 31, 2022, which is a 7.8% growth for these 5 years. By taking a closer look, company has a small decrease in revenue for 2019 before having a significant decrease in 2020, which is due to COVID. In 2021, revenue was increased above 2019 figures, and in 2022, revenue grew by 10.2% year-on-year. Graph compares the market expectations shown in gray with actual results shown in blue. IEW has met or exceeded analyst expectations in the last quarters, indicating that strong results are delivered by management. Gross profit and net profit before tax follow the same pattern identified when analyzing revenue, with a decrease during the COVID years but recovering in 2021 and 2022. Gross profit has increased by 10.22% year-to-year, but both net profit before tax and after tax have increased at higher rates, 15.5% and 12.6% respectively. These increases are translated to a gross profit of $6.5 billion and net profit of $3.8 billion. Operating margin is 25.1%, thrashing the 15% figures we want to see. Earnings per share growth has increased over the years, with a growth rate of 8.4% for the last 5 years. The increase in the last 3 years is even higher as it is 14.1%. Higher EPS means that the company is growing in value, and this is what we are hoping for Illinois Tools. EPS of Parker Hannifin and SMC Corp is higher, but the important aspect here is that it is growing at a steady pace while comfortably outperforming companies like Atlas Copco and Otis Worldwide. Company has increased its cash and cash equivalents from $774 million in September 2022 to $922 million on June 2023, representing a 19% increase in just 9 months. Despite the increase in cash, we see that total liabilities have increased by 2.21%. Total long-term debt has increased by 13.6% in the last quarter. A good debt-to-equity ratio is 1 below 1.5, but the company's debt-to-equity ratio is 2.5, confirming that the company currently has more debt than the desired levels. We have identified that the company has more short-term debt than cash and cash equivalents, and also highlighted the relatively high debt-to-equity ratio. Free cash flow is how much cash a company has left over after paying its operating expenses and maintaining its capital expenditure. Over the last quarters, we see that the company increased its total cash flow. In fact, free cash flow in the last 4 quarters is around $2.8 billion, which is an indicator that the company can generate enough cash to continue operations and meet its debts. Overall, income statement and balance sheet look very healthy, and the company has manageable interest expense and is able to organically grow and eventually pay dividends. Jumping to the share buyback policy, the company decreased its outstanding shares by nearly 30% in the last decade. Looking at the graph, we can see that outstanding shares in 2012 were 463 million, and in 2023 the outstanding shares were reduced to 303 million. Company's board approved a new $5 billion buyback program. In the first 9 months of 2023, the company bought back shares worth $1.1 billion. In 2023, Illinois Tool expects to repurchase $1.5 billion worth of shares. Companies that consistently buy back shares send a strong message that their financial position is healthy and generate enough cash not only to finance their operations but also reduce the number of shares, giving shareholders a higher stake in the company. P ratio is 25.2, which is a respectable ratio given the industry and how well the company has been performing over the past decade. Return on average equity and return on investment are an indication of how effective management is. Return on average equity is 95.9% compared to industry average of 9.2%. Return on average investment for the last 5 years is 20.8%, which is well above the 7% threshold we are looking for. Illinois is part of an elite group of companies to be considered a dividend king company. Dividend yield currently stands at 2.3%, a respectable yield which translated to $5.60 per share going forward. Over the past 5 years, Illinois Tool Works Inc.'s annual dividend growth rate for 5 years is 8.3%, beating the 5% threshold we want to see. Over the past decade, Illinois Tool Works Inc.'s annual dividends per share growth rate stands at an impressive 14.5%. Just by looking at the graph, it is evident that the company is a dividend growth stock, and in 2023 alone, dividends increased by 12.7%. Payout ratio is 51.7%, which is a very decent and acceptable ratio. Finally, dividend grade score is 80% and is well above the acceptable levels of 50%. Dividends are safe for the foreseeable future, and the company is expected to continue and pay out dividends. In fact, in August, company hiked its dividend by 7% to $1.4 per share. I have to admit that I currently do not hold any shares in Illinois Tool Works, but the company meets 8 out of 10 health check scores I am looking for when analyzing a company. Given the solid record and financial position of the company, it is a company that I will be looking to add to my portfolio. I must mention that this should not be considered a financial advice, and you should always do your own research before investing. If you have enjoyed this video, please hit that like and subscribe button so you do not miss the next video. If you want some stocks to be analyzed, please leave a comment below, and I would be happy to prepare a video. Thank you for watching and hope to see you soon.